Okay, fam, welcome back. So today we're going to be going over the macro markets overview for December of 2024. So with that being said, let's get it. Okay, so I'm sure you guys have noticed immediately on the screen there is another metric that I can point out to you guys that tells me that likely we probably are almost at a bottom on the markets. Now, it should not really come to a shock to anyone, especially if you've been in the traditional markets for quite some time. You know this is normal to get maybe once or twice a year, somewhere between a 5 to a 10% pullback. Okay, so you can see we had a 10% pullback here in September, pretty much right in line with seasonality. Again, in March, right in line with seasonality, about 6%. The unusual thing, I think, that is a bit strange. Am I surprised to see another correction considering how good the year has been? Not really, but the thing I find to be a bit strange is that it's happening in the middle of bullish seasonality. But keep in mind, there's other things at play. Okay, there's policy changes with politics. The Fed came out and decided to really screw the pooch by telling the people that maybe they're not going to cut as much next year, which I think is total BS. I think that's just the Fed trying to talk the markets down, which obviously they were very successful at, right? I've always said that the Federal Reserve is the ultimate market maker. Okay, they are. The markets literally hang on every word they say. It is the truth, whether anybody wants to admit it or not. Plus, you have profit taking, repositioning, tax loss harvesting. There's all kinds of stuff going on. So I don't really think this is going to be a bigger sell off, but let's just go with the what if. Okay. So you guys can see every time we got to the bottom of this channel, we have bounced. Again, we haven't always made it perfectly to the bottom, but we did get down here in July and August, again in September. We kind of tried to move towards it in November, and now we're back again at it in December. And every single time we bounced off of this, okay? And nearly every single time we have also bounced off the yellow EMA. As you guys can see here, that is the 21 EMA. So it's held nice and strong. I'm not expecting this to break down, but in the event that it does, keyword if, okay, and the futures markets are open. So I did not think they were actually going to be open today. Me personally, I am not going to trade the afternoon session because it's usually pretty boring. The real excitement doesn't kick in for futures until the Europe session or the US Open, which is for me personally would be midnight and 6:30 in the morning. So, but yeah, regardless, it's open. I'm actually kind of surprised considering it's New Year's. But anyways, so let's talk about it. So best case scenario, we could get a push. Let's just say maybe by the next time we're supposed to get some kind of maybe pullback in the markets kind of towards March 2025. I mean, do I think the S&P is going to be at 6,900 by March? Well, that's tough to say. I don't know. I mean, it depends on how extreme the Trump pump is. We'll just have to wait and see on that one. But I'm not the only one that thinks that the markets could go to anywhere from 6,500 to 7,000. The S&P specifically by the end of next year. There's a lot of people, a lot of smart people in the markets that think, even the banks think that these things are going to be going higher by the end of next year. And again, the global liquidity index would line up perfectly with that. As you guys know, we're not supposed to get a pullback on that metric until 2026. Okay. So best case scenario, we kind of shoot up to kind of, I don't know, somewhere between maybe 6,400 to 6,800 by March. It could take longer than that. That's always possible. It could take longer than that. Okay, keep in mind that if there is a pullback from there, it could pull back to maybe 6,500 right around March, April, and then start pushing up higher. That could always happen. That would be totally normal. Now, worst case scenario, we pull back to 54.20 to 56.50, somewhere in there. For those of you guys that are doing options, the measured move, and of course, I'm referring to the S&P 500 or the SPY in this case. If you're doing options looking for like leaps or something like that, this could potentially be a good area to pick. Of course, do your own technicals on that. I am not suggesting anything here, okay? But this to get up to 6,900 would be about a 17.5% move. Keep in mind that would be outperforming the standard for the S&P every year, which is about 10%. But if we get a further pullback, roughly about 7.8%, do I think this is going to happen? I mean, a 10% pullback once a year would be normal. It would be a little strange for it to happen in between the end of a year and the start of a year. So I would say the likelihood of this happening, probably not. Okay. I think we're probably going to go higher from here. So the other thing I wanted to pull up, and again, we rarely, almost never look at this. Okay. But once in a while, I do want to bring this up just to kind of keep this in the back of your guys' mind. So this is the macro bull bear indicator that we use. It is known as the 200-week simple moving average. Okay. And why are we using this? Well, you guys can see over the many, many years since the great financial crisis, this thing has served as major bottoms in the markets, with the exception of the pandemic, obviously. And even in 2022, again, it wasn't perfect, but you can see we pretty much bounced immediately off of that and went higher. And then again in October 2023, we got pretty close to it and then went higher. So at this point, that level is sitting at 4,500. 65. Do I think we're going to get a pullback like that? Yeah, I really doubt it. Not at this point in time. I mean, that would be officially a technical bear market, but I just don't see that happening right now. I mean, everything that is and everything that's going to be here soon looks way too bullish, in my opinion, to get some kind of crazy dump like that. I just don't see that happening. Save a black swan event, and even with a black swan event, I just don't see any black swan events happening anytime soon. So, yeah, so that's the S&P. Let's move on to the NASDAQ. So NASDAQ here, again, the triangle pattern target is all the way up here at 24,600. And keep in mind, we are kind of slowly, very slowly testing this. And again, I'm aware it's not really perfect. I mean, I could draw this any kind of way, but the kind of idea here is to get as many touch points as possible. So nice little fake out, then push back into the broadening wedge here, and then we got kind of a undercut and then a push back up. So we're currently retesting the bottom of this kind of rising broadening wedge, which is a bearish pattern, but keep in mind this pattern could play out for a long time before having a breakdown or never break down. That could always happen too. So I would say based on where the current support is, where the EMAs are, where the bottom of this channel is, the likelihood that we're going to sell off even more from here, very unlikely. Okay, I just don't see that happening. So same thing as before, I'll kind of push this out to March, April timeframe. Keep in mind that I don't think it's going to move up this fast within that short a period of time. I would be absolutely shocked if it did, but if it made it to the top of that channel by March, 26,400. Keep in mind the target for the top of this channel, 24,807. The EMAs sit at support roughly about 19,200 to about 21,000, so not bad. I think the likelihood that we've seen pretty much about as much of a pullback as we're going to get is already been priced into the market, in my opinion. Okay, so Russell 2000. Worst case scenario, we get down to 2120 here. I don't know how likely that is. This price action here is kind of janky, so it's a little difficult to get a feel exactly where structure is. But if I just draw a line right through here, you guys can kind of see it's been heavily traded there, so it's possible we may just bounce immediately off of that. So support zones anywhere from 2120 going all the way up to 2300, and then of course the target would be the all-time highs at 2480-ish. From the white line, 10% gain, and from the bottom EMA here, assuming the worst, roughly about a 14.2% gain. Okay, so Dow Jones. This is quite interesting. So this appears to be the most bearish of all the charts as of right now. I find that to be very interesting. Not shocking though, because the Dow Jones was the first one to hit all-time highs, if I remember correctly, before the rest of these indices did. And now it's obviously the one that's having the largest pullback. That doesn't really shock me at all. So down about 5.6%. Again, this is testing the bottom of this huge channel that we're in. That's more than a year old at this point. The likelihood is probably going to bounce is very high, in my opinion. And just going out to kind of this March timeframe, you guys can see the absolutely stupid returns this thing would have, 49,100. I mean, and again, on the RSI, you guys can see here, each time we hit a major bottom for this thing was right around the same level that we're currently seeing the RSI right now, roughly about that 54, with the exception of this one right here. So, yeah, just another indication that likely the bottom is probably in. Okay, so let's go next to the stocks above the 50-day. Now, obviously, we've talked about this, okay? We have not gotten into the zone even once since November of 2023, so it's been over a year since we've been here. Another indication to me, likely we are very close, if not at the bottom itself in the markets. Again, we've only hit this 1, 2, 3, 4, 5, 6 times in the course of 4 years. That is a major indicator that likely the bottom is in. Okay, it's a rare signal. Whereas on the sell side, again, we only hit it 7 times in the last 4 years. So recently we got there in September of 2024. Obviously, the the markets didn't like how overbought it was getting. It kind of slapped it down a little bit, and then obviously we are pretty overdue at this point, I would say, for a rebound to the upside. Okay, so next one here, NASDAQ. So this one did pull back even further to my surprise. So we're not quite at the bottom yet. Again, that's anywhere between a 1 to a 14, but I mean, a 25 is pretty low. That means we have about a 75% upside compared to a 25% downside. So again, the likelihood we are getting pretty damn close to a bottom here is very high, I would say. Again, we're not oversold completely on the RSI, but we're getting down there. Yeah, I mean, if you guys have been sitting on cash for a while and not buying anything because you thought it was too expensive, a lot of people in the markets did. Well, this may be, these may be some indicators that the opportunity might be at hand for you to, again, not financial advice, but maybe to consider deploying some capital on some positions that may be attractive to you on a dip buy. Okay, so stocks above the 200-day moving average on the NASDAQ, we're sitting at roughly about 50-50. So basically what this means is 50% of the stocks in the NASDAQ are below the 200-day moving average. 50% are above. And keep in mind, during that July-August dump, we were pretty much sitting at the same level that we're at now. And we had that obviously heinous October 2023. But you guys can see it rebounded sharply, going straight back past the level we're currently sitting at. So that could potentially be a local bottom indicator. Again, this is kind of an investor's indicator here. It's rare for us to hit these major overbought, oversold signals because this is a much longer term time frame indicator. Okay, so S&P 500, again, we're getting pretty close to the RSI being as oversold as it was back in October of 2023. That is a major bottoming signal, in my opinion, even though the charts itself is not showing it. So basically, 47% of the stocks in the S&P are below the 200-day. 53% are above it, is pretty much what this is saying here. I mean, it's not expensive, but not cheap. I mean, there's 500 stocks in the S&P. You could, of course, pick and choose which ones you think are the best deal. Go value hunting like Warren Buffett would do, right? All that kind of stuff. Okay, so 2-10-year yield, they're uninverted at this point. I don't really need to talk much about this. I think that the yields will come down, especially after Trump gets in office and he'll start kind of implementing some of his policies. That's inevitably going to happen. I'm not worried about the yields or resurgence of inflation or any of that crap next year. I think that's all dead in the water, and people are kind of overestimating how important it is. I don't think it really matters. I don't think it's really even going to be relevant next year, or this year, I should say. I'm just going to point that out. What I will say, okay, is this. When the yield curve uninverts, that is usually a major warning sign that in the next 12 to 18 months, there could be a recession. Am I saying there's going to be a recession? No. Do I think there's going to be a recession? Probably not. Do I think that we're probably due for a 5-10% correction at some point this year? Probably somewhere around March, August, September. Yeah, that's probably going to happen. But if I were just to roll from the time of the inversion out going forward in time, that would put us somewhere 12 to 18 months, somewhere in October of this year to roughly about March of next year. And keep in mind, the liquidity index is slated to pull back in 2026. So there is some correlation there. How relevant that becomes with time remains to be seen. So the Fed funds rate, it is coming down. Of course, they gave us this quarter basis point cut. Are they probably going to cut again this month? Yeah, they're probably going to do it. I mean, it would be kind of ridiculous for them not to. I mean, there's no reason to believe that. I mean, inflation's not going anywhere. It's sitting at 3.3 to 2.7%. So I highly doubt the Fed's not going to keep cutting. There is one other thing to consider with the Fed funds rate being too high for too long. The higher the Fed funds rate is for the United States government, the more expensive it is for them to pay the debt back that they owe to debtors from other nations. That's what the national debt is. Okay, the $34 trillion, that is the amount of debt that is owed on the national debt, which foreign investors may have a hand in investing in some U.S. debt with the intention of getting some interest. Okay. So technically, when those foreign investors own that debt, they own a piece of the United States. And I'm sure the United States is not interested in giving more to foreign investors than they have to, right? Plus, it makes it very expensive to pay down the national debt for the U.S. government if the Fed does not lower rates. And the national debt is at $34 trillion. So do the math, right? I don't know what 4% of $34 trillion is, but it's a lot more than 2% of $34 trillion is. Okay. So inflation is what it is. We don't need to talk about that. The unemployment rate, I'm expecting that to stay low. My thesis on that does not change. So let's see here. We'll go over oil real quick. So oil, my thought process on oil is pretty simple. It's probably going to stay in this range down here because, again, when Trump gets in office, he's going to want to drill, baby, drill, right? Be pumping record amounts of oil, all that kind of stuff. So the more oil you produce, even if the demand is extremely high, if they're pumping out 13 million barrels of oil per day and you have these tens of thousands of oil jobs created as a result, which probably is going to happen, that means that the price should be relatively low in comparison to where it was back in 2022 and should stay low. That's kind of what I think is going to happen. And of course, the ending to the wars overseas, that would obviously help, right? So 63 to 76 at support, 90 to 94 at resistance. There is a lot of potential upside here for longer term investors. Obviously, you want a cheaper price on your oil stocks and ETFs, right? So I'd say the current price looks pretty good, in my opinion, for a 41% upside. Okay, so now I'm going to go over the metals. I told you guys last time that we took a look at gold, that I thought gold was insanely expensive. Again, on the monthly time frame, every single time we get one of these overbought signals on the RSI on the monthly time frame, not the weekly, the monthly, it usually indicates a pretty massive pullback. Okay. In this case, in 2009, obviously gold went much higher. And then we kind of had like a bearish divergence, lower highs on the RSI, higher highs on the price. But eventually, with another monthly oversold signal, it did pull back a massive 47%. So we are hands off of gold at this point. It is very expensive, in my opinion. I would not touch this thing with a 10-foot pole. So 22% pullback from this indicator. And then, of course, the question is, how much of a pullback from the recent top? I would say going back to $1,800 an ounce, probably pretty realistic. Again, the last time, look, I'll give you guys an indication of the last time we bought metals. The last time that we actually bought precious metals was 4 years ago. Okay, well, actually almost 5 years ago. The last time that we bought metals was in March and February and April of 2020. Okay, where is it? Let me see if I can find it. So, yeah, we kind of bought like down here, $1,500 per ounce, and then eventually sold. Obviously, we didn't realize it was going to run up that much. We probably would have held longer, but is what it is. So silver is looking a little expensive too. I think likely this is probably at a top. Again, last time we got one of these signals on the monthly time frame, it was took a little while to play out, but you guys can see the dump was pretty heinous, so 40%. And then, of course, before that, another obvious indication of being overbought, minus 72%. I personally would be willing to buy silver more than gold at this point. I think gold is just outrageously expensive. If silver does have a pullback, maybe into this white line somewhere, kind of that $24 range, it could even go as low as $20.50. That's what I'd be looking at personally if I was looking for a pullback. With targets pretty much around the current price, 29 going up to 35 at some point in the future, because silver probably will gain value progressively over time, roughly about 72% gain here. Okay, palladium, this one I would say is extremely attractive right now. If you guys are looking for a metal to buy, this may be it. Again, it's probably not a very common metal, but hey, take what you can get at the prices that make sense, right? So 900 for the buy zone. This is a major decade-long support here. And the sell zone up here at 29.20 to about 34.40. Yeah, if I was going to buy a metal right now, palladium would be the one, that's for sure. So 266% gain here. Platinum, get rid of this accumulation zone because that's pretty much what it is. So buy zone down here at 776 to 820. Sell zone up here at 1750 to about 1920. I'd say the price on platinum is actually still quite attractive. Anything under 1,000, in my opinion, is a steal. So 150% gain here. And again, the RSI, last time we got close to overbought here at this 1340, it was a sizable pullback. And this is on the monthly time frame. Again, over here, a huge, massive pullback. Okay. And then again, yet another massive pullback after a huge, crazy pump. So keep in mind, whenever you see these massive overbought signals on the monthly time frame, might be time to be a little bit terrified. Just going to say that. Okay, so Bitcoin, the only indicator I'm going to look at here is on the monthly time frame, and or time frame, I should say, is on the monthly time frame. So nice big fat green candle in November, nice little pullback. That's a shooting star candle on the monthly. I'm not a big fan of that. That does concern me a little bit, especially getting this close to this kind of macro resistance. But look, I'm just going to be real with y'all. I think this resistance from peak to peak here is actually going to get broken this cycle because, again, we have a president that is pro-crypto. I cannot overstate just how significant this is, okay? We have a president of the United States that has come out pro-crypto, okay? Has come out endorsing crypto full stop, 100% bull mode, and is even invested in it, and is going to hire a SEC chair that is also pro crypto, and his VP is also pro crypto. Okay. We have never had a president in history, not Obama, not Biden, not anyone, that has come out and said, yes, I like crypto. I want to buy crypto. I want the United States to buy Bitcoin. We've never had that. Okay. That is a big deal. So yeah, this is probably going to get broken to the upside. All right. So the basis here is what we're looking for is for this 92,000 to hold. I do think it's going to hold. We'll go over why that is likely to happen in another video on Bitcoin. But the thing I want to point out here on the monthly time frame is, are we at the end of the cycle for Bitcoin and crypto? Probably not. Okay. We would need to see somewhere between a 90 to a 95 RSI reading on the monthly time frame to indicate we are potentially topped out here. Where, I mean, the highest we've seen so far is the 76. So yeah, I'm just going to be real, y'all. I don't think we're at a top yet. Okay. Keep in mind, when Trump does eventually force the Fed to cut rates, which I'm pretty confident is going to happen, the dollar index will fall off a cliff, which is the next thing we're going to talk about. And when that does inevitably happen, guess what? Crypto and Bitcoin are probably going to pump even more, okay? Because that's what happens. Again, the DXY and Bitcoin have an inverse correlation. When the DXY goes down, guess what's going to happen to Bitcoin? Boom, baby, rockets, right? Okay, so DXY here, it does appear that we have had a push on the monthly above this resistance level, which I did not think was going to happen on the 106 to 107. So next level up here, 112 to 114. Do I think that's likely going to happen? Probably not. here's what I will say is likely going to happen. Okay, this is probably going to turn out to be an overcut, and then Trump's going to come out and say, "Hey, Jay Powell, if you don't cut rates, guess what? We're going to fire you." And then we'll probably see something like this. Would be my guess, kind of going into, and I don't know that it's going to be this extreme, but we're probably going to see something like this going into throughout next year, because I do suspect the Fed is either they're going to willingly cut rates, or they're going to be pressured or forced to cut rates next year, because let's face it, Trump is a bull. He wants the markets to be bullish, right? And as investors, unless you're a bear, unless you're a perma bear, you obviously, if you're a bull, you want the markets to be bullish too, right? So we all kind of want the same thing here. We want the DXY to go down and Bitcoin and crypto to go up. So last thing here, the VIX, nothing really going on here. I mean, it's pretty much sitting at the lows. The thing I want to point out here is that every single time we've gotten one of these readings as of recently, anything kind of in this area that we've seen, what's happened, it's pretty much been a false reading. Okay. So we get this huge kind of scary signal, and then what happens? It just pulls back and the markets keep climbing. And we saw a very similar thing here in kind of that August time frame. And again, you can see that the VIX is slowly pushing downwards and not spiking up again. So obviously, what do I think about this? Well, it's pretty simple. I think that the fear is out of the markets, and I think the markets are good, and they have a very bullish 2025 to look forward to. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.